Since Lehman's collapse in 2008, the regulatory scrutiny on the financial services industry has only increased, and yet this summer is perhaps the busiest of all. I'm Les Kovach, editorial director of TabbFORUM. I'm joined today by Mayra Rodriguez Valladares. She's principal of MRV Associates. Mayra, thanks for joining us today.
Hi.
Why don't you give us an update on the regulatory activity taking place this summer?
Basically, the Basel Committee has come up with 8 very, very important guidelines, and 2 of them in particular are really going to impact the globally systemic important banks. And in the US, obviously, that would be JP Morgan and Goldman Sachs, Citibank, Bank of New York, Wells Fargo. Those are obviously the biggest bank, the top 8. And primarily it's the leverage ratio. There are new guidelines that update the 2010 framework. And essentially what's important there is that there will be a higher requirement in terms of quality capital that will be required of these banks, but also importantly, what is covered. In other words, what's in the denominator. People often say, well, you know, assets are on balance sheet. That's what they think about. They think about loans and bonds. But this actually is much more encompassing. It's about repo transactions. It's about derivatives. So that's one major guideline. And the other major guideline that's come out, and it's all in the proposal stage, but that is how will the banks, again, the large banks, have to account for the counterparty in a derivatives transaction. Certainly the financial crisis taught us that sometimes it's your counterparty that is the serious problem in terms of credit quality and could actually declare bankruptcy or default before your underlying asset. And then there's other important guidelines that have come out of Basel. For example, whether we really need uniformity in calculating risk-weighted assets, because right now the banks have incredible amounts of flexibility in how they calculate their risk-weighted assets. There's also a discussion, a proposal that has come out about whether there needs to be a change in Basel overall. Has it become too complex for the banks, for the rating agencies, for the potential investors to understand, and maybe even more importantly, for the supervisors themselves? So these guidelines are all incredibly important. I really think we're at the beginning possibly of Basel IV, because all of these guidelines are so impactful not only to the banks but to the financial sector at large.
You mentioned the leverage ratio. There's been a lot of debate about how much capital is enough capital. What are the different proposals that are out there? The
basic proposal in 2010, the leverage ratio was supposed to be 3%, and this was tier 1, in other words, again, the high quality capital to cover assets, but a broader definition, not just on balance sheet transactions, but off balance sheet, the derivatives, things like that. And that clearly is too low when you talk about these enormous, you know, multi-trillion type of banks. You know, I'm talking about JP Morgan, that's $2 trillion, or you know, Citibank, Goldman Sachs. These are very, very large banks. So 3% is too little. So what's happened subsequently, the June 26th leverage ratio proposal that's come out of the Basel III committee, and that will be in discussion, it's in comment period until September, basically keeps that number. So it's 3%. However, the denominator is much broader. It'll encompass the derivatives. There is special treatment if you're a seller of protection in a single name CDS, for example, because there you are as a seller of protection, and very, very unexpectedly something can happen in the market that you end up having to pay a very, very large unexpected sum of money to the protection buyer. So that is the Basel proposal in a nutshell, and it tries to deal with the fact that banks, especially in Europe and in the United States, are using different accounting type systems. And so what happens is that in the US, these large banks, JP Morgan, for example, it's actually much larger than it is stating according to US GAAP, because the derivatives are off balance sheet. If you were to do IFRS, JP Morgan would actually probably be an institution of about $4 trillion. And so what that means is definitely, even something like 5% is too low. So in the U.S., what just happened on July 9th, spearheaded by the FDIC, is that the U.S. proposal, taking obviously a tremendous amount of guidelines from Basel, is that for the bank holding companies, they should hold 5%. It should be, the leverage ratio should be 5%, and the bank subsidiaries, the depository insured subsidiaries should be 6%. And so I think now what will happen is I feel really that the American regulators are quite emboldened this summer. It would not surprise me if they then say not only should it be 5% and 6% respectively, but that also the denominator should be more encompassing, like what the Basel guidelines are recommending. And so this will very much have a very huge effect on Goldman, Wells Fargo, Citibank, and JP Morgan.
This week, coincidentally, banks are all reporting record profits or record earnings. What's the brouhaha? Why are they concerned about how much capital they need to hold in reserve?
Well, really, this is precisely the ripe environment to have not only stronger regulations, but more supervision, because the banks can afford it. What's happening right now is that the banks wouldn't be making these enormous profits if they weren't so leveraged. They are incredibly leveraged, and during the good times, people tend, unfortunately, not to worry about it. But what we really need to remember is that capital is an incredibly important tool to try to improve the safety and the soundness of the banking system. This is what this is about. And so you want banks to have more capital. Now, more capital means not only in terms of more tier 1 over risk-weighted assets, more capital means also in terms of a higher leverage ratio. More capital also means for those banks that are the globally systemically important ones, they should have what's called a SIFI charge. And you want to increase capital during the better times, because if we wait until the next time there's a downturn and the regulators then try to propose these guidelines, then the entire banking community and maybe even some regulators themselves will say, oh, this isn't a good time to increase capital. So this is precisely when you want to do it.
Well, it certainly sounds like regulators have their work cut out for them this summer, and obviously the impact on the banks is potentially huge. I want to thank Mayra for joining us today,
Yes.
and thank you.